So let's start with long-term financial planning, okay? The starting point for us is going to be financial forecasting. So we're going to be examining financial statements as we did in Module 1, but we're going to be thinking about the future. Forecasting, it's the key word. Thinking about how the financial statements are going to look like in future years, okay? So why do we do that? Why would a financial manager have to forecast future statements? The examples we're going to cover in this lecture are mostly about financing needs, okay? So we're going to be forecasting future financing needs of a company, okay? It's a very important corporate finance decision that we're going to be learning on this module, okay? But forecasting has other uses as well, right? So a very important use of forecasting is to forecast cash flows for valuation. So when you value a company, you have to forecast future cash flows and to come up with a value for the company. That's another important use of that. And a third use that is very important in practice is to estimate the impact of new projects and acquisitions on a company. So if a company takes a new project or if a company acquires another company, how is that change going to affect the financial statements? And as we're going to talk about when we go to mergers and acquisitions, we're going to learn a little bit about that, okay? So forecasting is a very important topic, very useful. The specific example we're going to be talking about in this module is financing an aggressive expansion plan, okay? So we're going to have a company that requires a large future capital expenditure, okay? And this company has to figure out whether and when it will need to raise long-term financing to support this expansion, okay? And when we think about long-term financing, we are thinking about a new debt or equity issue, okay? So will the company generate sufficient cash internally? So does the company have sufficient cash from operations, or will it need additional funds? Is the company going to need to go to the financial market to raise more funds? Okay, that is the question that we're going to be answering. And to continue the theme that we started on Module 1, I think it's extremely important to try to deal with real-world financial statements as much as possible. So as much as we can, we're going to be dealing with real-world companies. For this specific example, we're going to use financial statements from PepsiCo, okay? So we're going to work with actual financial statements from PepsiCo and consider the impact of an investment program, okay? So there's going to be specific assumptions we're going to deal with. We're going to start with 2014 year-end financial statements, okay? So those we know already. They were reported, they were audited. Those are solid financial statements, okay? And then what we're going to do is we're going to engage in a guessing game, okay? We're going to try to guess what's going to happen in the future. As we're going to learn, perhaps the most important forecast is the revenue growth. Okay, revenue growth is going to affect everything, right? For the revenue growth, we're going to have specific numbers. So revenue is going to be growing at numbers that we are actually going to take from Capital IQ. So those are actual forecasts made by analysts. What's going to happen to PepsiCo in the next couple of years? What they are forecasting is that there's going to be negative revenue growth in 2015, and then positive revenue growth again in 2016. The numbers are there, minus 4.4, 4.05%, okay? And then we're going to come up with an expansion plan, okay? So PepsiCo, this is going to be an assumption that we make. We actually don't have this data. It's very difficult to get data on capital expenditure plans from real-world companies, so this is an assumption we're going to make. PepsiCo is going to need to invest $3.5 billion in 2015 and $6.5 billion in 2016. Okay, so we came up with that. As you can see, it's a very significant capital expenditure. Okay, and then we're going to have other assumptions. Investment in net working capital is going to be equal to 2% of revenues. Okay, and then we're going to have interest payments being equal to 4% of 2014 total debt. Those are reasonable forecasts. And we're going to keep the same dividend policy. So the PepsiCo is going to keep paying a constant fraction of net income as a dividend. Dividend is also a use of cash, so we have to forecast dividends as well, okay? And then the question we're going to try to the question we're going to try to answer is whether the firm can finance this expansion without issuing new debt or equity. Okay, does the company need to go to the bank to get more cash, or does it have sufficient cash flow to finance this expansion plan?